we just got a masterclass in market whiplash. In just a few hours, we saw geopolitical hope get completely shattered by reality, and that triggered a huge reversal across, well, pretty much every asset class. Today, we're going to break down exactly how this ceasefire that wasn't all went down, and more importantly, what it means for the week ahead.
And this quote, it just perfectly captures the mood, doesn't it? What really felt like a moment of de-escalation was, in reality, just the eye of the storm. Markets got a taste of relief, but man, it was short-lived. It was just setting the stage for the chaos that came next.
So, here's our game plan. We'll kick things off with that short-lived ceasefire and the risk-off reversal it caused. Then, we're diving deep into the technicals for major currencies and taking a close look at India. And we'll wrap it all up with the big battle brewing between economic data and geopolitics. All right, let's start with the event that kicked this whole thing off. A so-called ceasefire that honestly had a shelf life you could measure in hours, not days. This was a classic case of markets getting way ahead of the actual diplomatic reality on the ground.
You know, what's really wild about this is just the sheer speed of the U-turn. On one side, you had all this hope, a rare synchronized global rally. I mean, equities were soaring, oil prices were falling, the market was pricing in peace, and then, bam! Reality hits like a ton of bricks with the announcement of a naval blockade, and just like that, all that optimism was gone.
So here's the key takeaway. This was never really a breakthrough. Expecting a full resolution in just 21 hours, that was always a long shot. The talks weren't about compromise. It was more like each side just laying down their non-negotiable positions. There was zero structural progress made, which means that foundation the market rally was built on, it was basically made of sand.
Okay, so now let's track how this diplomatic failure snowballed into a full-blown risk-off event. Because as soon as reality set in, the market's reaction was immediate, and it was pretty severe.
First stop, oil. It just screamed higher. Brent and WTI both jumped by as much as 8%, slicing right back through that huge psychological $100 level. Think about it. The Strait of Hormuz, which carries almost 20% of global energy, was suddenly a major choke point. Supply fears became very, very real.
Equities, of course, felt the pain instantly. You saw U.S. futures just slide, pointing to a massive 580-point drop for the Dow right at the open. Investors were just dumping risk at the first sign of serious trouble. So where did all that money go? You guessed it, straight into the U.S. dollar. The dollar index, the DXY, shot up to a one-week high. It's the classic flight to safety. When global stress spikes like this, everybody rushes back to the world's reserve currency.
All right, now for what you've been waiting for, the technicals. Let's dig into the charts and see how this geopolitical shock has completely reshaped the landscape. We'll look at the key levels you need to be watching across the major currencies.
Okay, first up, the dollar index, the DXY. The level everyone is watching right now is that 50-week moving average at 99.18. If we get a clean break above that, it could signal a lot more strength to come. And don't forget, this risk-off move is happening right on top of strong fundamental support for the dollar, especially after that hot US CPI data showed inflation tripling. That just adds fuel to the fire for a hawkish Fed.
The euro, meanwhile, got sold off hard. That resistance at 117.30 is looking like a pretty firm ceiling right now. You see, it's getting hit from two sides, the flight to the dollar and Europe's own problems at home, especially with those surging gas prices. All this makes the upcoming commentary from the ECB even more critical to watch.
Now, sterling is in a really interesting spot. That sell-on-rise technical structure that was so clear before, it's completely muddled now. Its direction is pretty much at the mercy of geopolitical headlines. All of its recent strength just evaporated. Keep an eye on 134.50 for key resistance, and that 50-week moving average around 133.65 is going to be critical support. Turning over to USD/JPY, the yen just keeps underperforming, and the structure here is still a very clear buy on dips. The big hurdle is that key resistance at 159.77. A break above that, and you're going to hear intervention talk come right back to the forefront. But you know, the real story here might be in the bond market, with Japan's 10-year yield creeping dangerously close to that sensitive 2.5% level.
Okay, let's pivot and shift our focus to India. The ceasefire hopes had really fueled a significant rally there. So let's take a look at how this sharp reversal is now impacting both the rupee and the Nifty 50 index.
For the rupee, this big risk-off move just reinforces the weekly buy-on-dips view.
And here's the thing to know. The offshore markets are already reflecting this renewed risk. The pair is trading about 40 peso higher, so that puts the key resistance at 93.40 firmly in focus.
The Nifty 50 had just snapped a 6-week losing streak, right? It posted a huge weekly gain on those ceasefire hopes. Well, now that entire rally is being questioned. The buy-on-dip structure that had been working so well suddenly becomes a lot trickier if this risk-off mood sticks around. Resistance is way up at 24,172, with a few layers of support sitting below.
So, what's next? Well, the week ahead is really shaping up to be a classic tug-of-war. We've got a heavy calendar of economic data, but it's all competing against these completely unpredictable geopolitical headlines.
And I mean, it is a heavy calendar. We've got inflation data like the PPI in the US, plus reports from Europe and India. We've got GDP from the UK and China, and key releases from the Fed and the ECB. In any normal week, any one of these could be a major market mover.
But these are not normal times. And that really brings us to the final, most crucial question for the week ahead. Despite all that data, despite everything on the calendar, will the movement of oil tankers in the Gulf matter more than anything you can find on a spreadsheet? Right now, all signs are pointing to yes.